Now, as we shift to the international market, we want to look at what are some of the issues that are coming about. And one of the biggest one is India talking about how their two largest buyers are not going to buy any more Russian crude ahead of the limitations that Europe is going to put on it, which are supposed to start in the beginning of December. And that's on insurance, boat availability. And up to this point, India said they will continue to buy it. There's no stopping them, just given price. But there's also a certain amount of, well, they've bought a lot. And you can see in general where they were previously and how much they've been buying since then. And you get an idea that you're going from not buying a whole lot to buying a decent chunk every single month, every single week over that period. Well, shipping rates have gone up. Floating storage has gone up in the area. So you also have to digest some of those things. So you can now, India can play both sides. They can come out and say, well, we support Europe. We're not going to buy. But realistically, do they have the capacity to buy anymore? Do they have the demand for it? And especially when you look at those timing delays, that's where we see some of those different shifts. So flows to China, India, and Turkey peaked in June at that 2.2 million barrels a day. 4 weeks to October 14th, that figure was down by about 350,000 barrels a day. Shipments to Turkey have risen, and you're starting to see more of that unknown, because what you're looking at is Russia's trying to preemptively move more product into Asia, and just because they know that the demand is going to be there out of most places. So put it in that area, get it there preemptively, and then as it's located, you can then pivot to where you need to go. Meanwhile, trading houses and refiners are racing to book storage tanks in Rotterdam in the coming months on expectations of supply crunch after the EU sanctions take effect. So there's a lot of these unknowns in terms of, well, when those EU sanctions take effect in the beginning of December, how is that going to impact things? And that's when you start looking at, well, if Russia, obviously they're not going to hit their target, even the new OPEC number. So what does that mean for the actual target? So when you look at the cuts deconstructed, and I thought this was a very good way to factor things in, the announced cuts were for 2 million barrels a day. Now, they calculated that the actual cut was 1.1 million barrels a day, which, as those that have been watching us, I disagree with. I don't think the UAE is going to cut. I don't think Iraq is going to cut. And if you go back through since the OPEC plus cuts have been announced, Iraq has continuously gone above and beyond what they were supposed to. And since July of 2020, that then increased into July of 2021, the UAE has been annoyed, if you will, in terms of what their cap is. So they've also been producing above that level. So that really puts us now at about, let's call it 800,000 barrels a day of production cuts. But then when you look, Kazakhstan is increasing by 560,000 barrels a day. We have that closer to about 400,000 barrels a day, just because the increase is not the full amount. It's something closer to 400, 450. And then there's that number of cuts not made of 100,000. So realistically, when you look at the different backdrop, you kind of get to a similar number in terms of what I'm looking at of the actual cut of being about 200,000 barrels a day. Again, we're just starting from a smaller offset. We have a smaller offset. We have a smaller increase. And that's, again, factoring in some of these different pieces coming to, because if you remember when we wrote on our insights a couple of weeks ago, our view was that the actual cut was going to be 250,000 barrels a day. Then we said, well, based on the 2 million versus actual, it's probably closer to 750 to 800. But then once you start factoring in Kazakhstan, Libya coming back at the highs, that's where you started to see some of that come down, putting the actual cut closer to 200 million. Now, it's going to be interesting to see what happens, because Iran, remember, is exempt from the cuts. They've been selling, but with their sale of the suicide drones to Russia being deployed in the Ukraine, Europe is now putting more sanctions onto Iranian crude, because remember, Iranian crude has been flowing into the market. As much as we say we're not sure, we know. I mean, we have satellite data, we have AIS transponders, we have enough eyeballs in the sky that we can find these things, these ship-to-ship transfers. But with Europe now getting more aggressive on Iranian crude, that's going to be a bigger issue, because now are they going to start to clamp down on their ability to circumvent some of the the more lackadaisical levels, especially and there's multiple reasons why. The human rights side, when we look at the protests against women, against people that are against or protesting against the regime, and now you see suicide drones being used against Europeans, as Eastern Europeans, which again creates some of those other issues. Now, when you take that to the next level, I think it's important to factor in where things are in the Middle East right now, and then go through how those cuts are going to impact what is happening with Middle Eastern crude. So Middle East crude oil floating storage still remains at 2022 highs. You can see outside of 2016, it's the highest it's ever been. 2016 is obviously coming back from when we had the OPEC price war, but we're still at a very high level and not much happening. But when you look at India and China and what they're willing to take with Urals, well, they still have contracts with the Middle East. And when you look at the different setups, there's destination restricted contracts with them that they don't really want to give up. So they'll take their term. They're not going to, they likely won't buy additional. They'll take their term piece and then they'll fill in that excess coming from West Africa, coming from Russia, but they're still going to take their piece. So the view that there's going to be an excess, which is what the hope was, has gone away. So November has already shown that Asian buyers are taking their full term allocations, therefore leaving little extra Middle Eastern crude in Europe to go to Europe, especially when you factor in some of those cuts. Now, we have seen some softness come into Middle Eastern pricing, so that could open up some additional flows into Europe, but we're not talking about huge shifts. It's just going to be maybe one or two that are additionally available. And the reason why that's important is because Russia crude oil production will continue to weaken when you consider the different pieces. But now when you look at the extra Middle Eastern crude that would have been on the market that's no longer there, the reason why that's important, and you can come back to why on the distillate front, is Middle Eastern crudes have a high disti cut. And that's one of the big pieces when, as we talked about in segment 2, there is a shortage of distillate. So the hope is, and the goal is, to buy as much distillate rich or distillate elevated crude as possible in order so that they can maximize production and underlying yield. So now when you look at the Mediterranean refiners, they were designed to run Arab light, Arab medium, or Iranian crude. Now, Iranian crude is under sanctions, and based on what's happening in Russia, the sanctions will get tighter. And they were also designed to run Arab light and medium, which when you look at Saudi Arabia, who is going to cut, they will be the ones to take things down. That's going to cut the amount of Arab light, Arab medium, and then the term is going directly into Europe, so into Asia. So then when you look at northern Europe, they were designed to run Urals. So all three are fairly interchangeable within a certain degree, but two were completely unavailable to European refiners, Urals, Iranian. So now you have more competition for the Arab light, Arab medium, which is going to increase or at least put a floor in some of that demand. And that's why it's going to be important to look at what is pricing doing, what is floating storage doing in the Middle East, because based on this backdrop, we should start to see the floating storage come down. If we don't, that would be a net positive for Europe, because that would enable them to pick up some of those additional cargoes. So when you look at West Africa has opportunities, but as we talked about with the varying grades coming from Nigeria and Angola, some of them are distillate rich and some of them aren't as distillate rich because they're on the medium sweet side. That medium side, not as heavy, which is going to eliminate the amount of resid they have, and again, kind of steal that carbon. If you remember how we've talked about what the coker does, what the cracker does, and the coker will take its share of carbon, but then it won't allow for a maximum crack in terms of what it steals at the beginning. So some of this data did come from Big Oren. I was just adding in my own little flavor based on what I'm seeing as well. but those are some of his backdrops that was broken down between Northwestern Europe and the Med, which I think is very important when you're looking at the different construction and the different types. So then when you look at the U.S., as under this backdrop, you're going to continue to see the U.S. Export extensively, where right now it has us about 4 million barrels. Again, it's something closer to 3.7, 3.8, but that's going to continue to flow into Europe because they're going to try to use the lighter sweet, maybe cut it with some of the heavier stuff that's available, Libyan crude, to try to create a blend that they can operate with at best. So here, when you look at Dubai Brent, you can see that Dubai has gotten a bit cheaper to Brent, coming closer to about $7.20. And as we see that floating storage remain elevated, you're going to see some of that additional weakness come through, which should start to move some of those cargoes out. And as you get that readjustment, that should keep us at a fairly tight range between that $6 and $7. So then when you look at global crude oil on the water, we're back to all-time highs, seasonally adjusted, obviously, and the highest level since the highest level for 2022 because of crude oil on the water, because of the floating storage side. And a lot of it is due to the transit. So when you look at crude oil in transit, this is a record, which is why tanker rates are so high. And you're just seeing some of these different problems when you're looking at the availability of tankers. So with India saying, we're not buying Russian crude, well, how much would you spend on that ship? If you already, based on this number, some of those boats that are being represented in 2022 are going to India. So why are you buying additional if you already have a backlog coming into your coast, which is why we've seen some of that buying slow down, and you have seen some additional buying from China now that we have some additional clarity on the export and import quotas, while export was, the import side is very much on the low end. Floating storage bouncing around again as that crude oil in transit shows up. That's going to push us back, and based on timing, will push us back above where we were for 2021. Asian floating storage is the one that we think is going to have the biggest increase based on activity from Chinese buying, based on activity from India and other nations. It's not going to take us to new all-time highs, but just much closer to where we were in 2021 and keeping us at that over saturated level on the crude side, while distillate continues to remain in a bearish backdrop overall. China's super tankers, you can see timing-wise, there's always that purchase. You can see that the purchasing happened a little bit earlier versus where it was in 2019, and it's just based on when were the import quotas announced, who got the import quotas, did you see some opportunity? And some of this is going to be China, is going to be China buying Russian barrels, buying Middle Eastern barrels, and starting to pick up some of those stranded West African ones just to create that blend, which is supportive when you look at the Shandong independent refiners, which are moved back to that 2021 level of 68.4%. And if you remember a couple of weeks ago, our view was that you were going to get 2022 Shandong activity back to about 68%, and that was on the backdrop of trying to get the state-owned assets from 75% to 85% production rates and utilization rates, so you get both kind of moving in the same direction, but they're going to cap out. Now when you have a reaffirmation of COVID lockdowns, zero COVID policy, more lockdowns being announced, we continue to see this as a big overhang on economic growth, economic consumption, mobility, which again is going to keep things fairly slow. The other problem is, and we're going to talk about this in the Econ Show, segment 5, is China has delayed again a lot of their economic release, which is, I think, problematic when you consider what those numbers are going to look like, likely not wanting to overshadow the current Congress meeting. West African flows West African floating storage has dropped. That's been a positive, and again, you're seeing some of those prices come down in order to incentivize some of those movements, because November so far has been fairly slow on the Nigerian front, and that comes back to our commentary regarding the slowdown on an economic side, the demand side, and some of those Middle Eastern cargoes getting a bit cheaper and just taking up those term pieces. So then when you look at what the U.S. has dropped on the gasoline export side. Gasoline exports have dropped 271,000 barrels. That's just 20,000 below the 5-year. Distillate volume has fallen 222,000 barrels a day, 149,000 below the 5-year. But we still think we're going to hold fairly close to that 5-year as we get that balancing act on the PADD 3 side, with propane propylene taking a step down of 432,000 barrels a day. Again, that nice surge coming back down a bit, and then you had that big jump in crude oil exports, which, as we said, will start to again level itself out. Now, when you look at gasoline exports, as we were saying, a 5-year average slightly above, but we're just going to stay at the top end of that cloud. With on the distillate side, our view was that we were going to go a bit closer to the low end, a little bit below the 5-year, and we had stayed much higher. So just given what the backdrop is in Europe, in the Atlantic Basin, we do expect this to remain above the 5-year average. There's a lot of timing delay in that. You can see that big drop. We do expect this to have a bit of a recovery back above the 5-year, keeping that movement. Ethane exports picked back up. Again, it's going to be fairly lumpy, but there is still that kind of beholden demand that goes into the Asian markets. When you look at crude oil exports, again, still going back to the highs. But as we talked about, the 4-week rolling average, that 3.8 million barrels a day still remains the case, with propane, propylene just still maintaining. But as we have slowing petrochemical demand around the world, a little bit of a slowdown in the NGL side, this is going to be important to watch to see how much of this gets stuck on the coast versus moving into the market. And if it does go into the market, at what price? And that's going to be a key one in general. So as we go to Fujairah, just to be clear, we covered Europe and Singapore last week because the EIA show was on a Thursday, so we were able to already cover it. So then we'll be able to we'll get back to it and add it not next week but the week after. Just because I won't be doing the EIA show and Econ show next week, just because I will be traveling for work in Canada. So now when we turn to Fujairah. Fujairah reported 22.458 million barrels, a fall of 2.46. The stocks saw draws across all 3 categories in general, with the greatest overall drop in middle distillate, as we saw a big chunk of that is currently flowing into Europe. Light distillate fell 336,000 barrels a day. But then when you look at east of Suez gas oil complex, that mixture of activity, where as we see the demand coming through, because remember, Diwali is coming in. India normally increases some of that demand, but supplies were heard to have been sufficient to meet demand for Diwali. So again, as we get towards the end of that festival, we should actually see a fairly big acceleration in storage, which will be a net negative for the crack spread when you look at gasoline versus distillate, because you're relying on distillate to carry the whole spread as gasoline continues to build. When middle distillate is trying hard with another drop of 795,000 barrels in storage, the gas oil complex was expected to come under pressure with higher outflows of gas oil from China, particularly in November, that are being anticipated on those export quotas, which could, again, push some of that down. So realistically, we think that China is going to increase underlying storage, but you're starting from such a low level that it's going to provide a bump. But the issue is, as that Chinese product comes into the market, is that going to hurt the crack spread to a point where now, because of the negativity from gasoline, now distillate will be profitable, but is it enough to carry the negative side of gasoline? And if it's not, that's where you start to get those economic run cuts, which we think could be a bigger problem. But then as you go east of Suez gas oil complex, has been so far resilient, with those arbitrage lanes to the west remaining open. And that's where we should see that come through. It was obviously aided by the French refiner strike. But as that looks to be coming to a close, that could close that arb just a bit, which will be something to watch. On the heavy resid side, volumes fell 1.331 million. Demand at the bunkering hub was seen easing, with buyers having covered some requirements. So again, we don't have a bullish view in terms of where shipments are. The question is going to be, do you get that flip from people and countries running middle distillate for power burn, switching to the heavy resid just based on price? Brent time spread strengthened. That's something that, again, we expected to be fairly range bound here, as we said, between that 150, that 170 level. We just kind of see it hanging out in this level, just given the different pushbacks in terms of what is available in the international markets. Angola put out their estimates for December at 1.117 million barrels a day of exports. You have the North Sea, which is at 780,000 barrels a day in November, which is at the high end. And then obviously when you start looking at the other areas of Norway is at the high of 1.675 million. The bigger shift is going to be where are we in November and what is flipping over. So Vital offered Manji for November loading. Angola plans to increase exports, as we talked about. But then when you look at the nation's crude for November loading has been mostly sold out, while next month's export cargoes from Nigeria are proving very slow for buyers. So Angola's normal clip, but Nigeria is the overhang. So that's actually creating some discounts. So Vital offered Gabon's Manji loading at $5.35 less than dated Brent. And that's something where we should see some of that pressure come in as they try to incentivize some of the movements from West Africa. Exports, so when you look at in general, there was a movement of a deferral from November into December for Angola, which resulted in some of that shift. Then when we look at 4 ships of Angolan crude are still looking for final destinations out of 35 regarding the November sale. Some cargoes could get reoffered or be retained for processing in the seller's own refining system in Europe. So we are getting some of those Angolan cargoes going to Europe, but Nigeria is a bit more fleeting in terms of where it can go or how it would go in different locations. And then compares with 3 to 4 unsold October shipments out of 32 planned. So fairly in line with where we were last month. More than 20 on the other side, Nigeria, more than 20 cargoes of Nigerian crude for November loading are still searching for buyers out of 31. And sales have been slow this month, with some grades failing to attract as much interest from Eastern buyers like IOC, like Pertamina. And again, a lot of that is driven based on taking that term from the Middle East, taking Russian crude, and just not having as much demand as initially expected. Then when you turn to 4 consignments of Congo crude have yet to locate buyers out of 7. That's slower than around a month ago when just 1 October crude was seeking a buyer. So Nigeria and the Congo have been slower. And the Congo slowdown, that is also showing some softness going back to China. And some of that would likely go into the European market because they do like those Congo cargoes. Vital, when we turn to Europe, Vital's bid for Fortes for November 8th to 15th at dated minus 45 cents. Previous versus unchanged. We expect to see some softness come in, especially from the West African side, trying to find a home. And that's going to be something to watch in general. So now when we turn to Genscape from Europe, you can see that there wasn't too much change. So it's going to be an important one to watch as we look at how things are adjusting with France, because as France starts to come back, those refiners, we should see that move closer to that 10-year or so average. When you look at North Sea crude oil floating storage coming down a bit, again, some of that timing delay of what is moving into the market, what is staying local. And then when you look at Europe, we had that drawdown with, again, that conversion from offshore to onshore. So that's what we have for you today. If you have any questions, please reach out in the comments section. You can find me on Twitter, and we hope you enjoy the rest of your day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.